Real estate investing. The dream is passive income. The reality is a spreadsheet that argues back. Veronetta Johnson covers exactly that tension in this episode, what the glossy guides leave out.
Right. We're looking at the hidden costs and risks that catch investors off guard, from cash flow gaps to market cycles. Let's start with what's actually lurking beneath a promising property listing.
The central question here is why so many investors enter real estate with solid projections and still end up surprised. The gap between what looks good on paper and what actually performs is the real subject, and it starts with cash flow assumptions that don't hold up.
The Post sets this up directly. Even in strong rental markets, unexpected repairs, tenant turnover, insurance increases, and seasonal vacancies can significantly reduce net income. What appears profitable on paper may perform very differently once real expenses are factored in.
So the upshot is that the math most new investors run is optimistic by design. It assumes full occupancy, stable costs, and no surprises. Real properties don't cooperate with that assumption for long.
Vacancy risk is one of the most concrete examples. Every turnover brings cleaning costs, repair costs, marketing time, and screening time, all before a single rent check arrives from the next tenant. Short gaps compound into meaningful annual losses.
And then there's the maintenance escalation problem, which is less dramatic than a vacancy, but relentless. Roofs age. HVAC systems fail on the hottest weekend of the year. The Post is clear that maintenance is a recurring obligation, not a one-time line item.
Deferred maintenance from previous owners makes that worse. A property can look cosmetically clean and still carry hidden water damage, foundation issues, or outdated electrical systems. Thorough inspections and property history reviews are the defense against inheriting someone else's neglected repairs.
Financing structure adds another layer. Leverage amplifies returns when things go well, but mortgage payments don't pause for vacancies or rate resets. Adjustable rate loans in particular can quietly erode cash flow when market conditions shift.
The Post also works through tenant behavior, legal compliance, insurance cost creep, property tax reassessments tied to appreciation, and neighborhood change over time. Each one is manageable in isolation. The challenge is that they arrive together and compound.
Liquidity is the one that tends to catch people emotionally. Stocks can be sold in seconds. A property can take months, and market downturns don't wait for convenient timing.
The Post's closing argument is that these aren't barriers, they're variables. Investors who plan for vacancy rates, maintenance cycles, financing risk, and regulatory changes are simply better positioned than those who don't. Preparation is the differentiator.
Understanding what isn't visible at the start is, as the Post puts it, exactly where the difference between success and struggle lives.
The through line here is that real estate rewards people who plan for complexity, not just opportunity.
Next time, maybe we'll find out what the market looks like once you've done all that planning. Worth sticking around for.